Hello and welcome to The Print. This is Akanksha Mishra and you're watching Macrosutra. Today's episode's format is a little different because our guest is unwell, but she did not want to miss this episode, specifically this topic. So let's get right into it. Last week, the Indian government released the GDP numbers for the last quarter of the financial year that ended in March 2025. And we witnessed the fastest growth in a year, with the GDP growing 7.4% year on year in Q4, which means that the annual GDP growth for financial year 2024 and 25 is estimated at 6.5%, which matches our previous second advance estimates also. Now, to look more closely at these numbers and discuss about which sectors drove up our growth, which need attention, and what the outlook is like for the upcoming financial year, we have with us Radhika Pandey, Associate Professor at NIPFP. Thank you for being with us, Radhika.
Thank you, Akanksha.
Now, there are quite a few audience questions, but and we will take them. But first of all, I think, Radhika, can you tell us a little bit about what was the main reason for such growth in Q4 and what sectors did it come from mainly?
So the GDP growth for the fourth quarter came in at 7.4%, and it was primarily led by higher investment growth. But before we delve into the drivers of growth, it is important to understand that the 7.4% growth was much higher than expectations, and that is due to the fact that it got a boost due to higher net indirect taxes. Now, net indirect taxes means indirect taxes minus subsidies. During this quarter, the January to March quarter, the government subsidy payout witnessed a contraction, and therefore the net indirect taxes as a component got a boost, and that is added to the GDP, and therefore GDP showed a growth of 7.4%. If we exclude these complications and if we only look at the growth, which is the production side, the GVA, actually GVA grew only at 6.8%. So that's a very important point to be made when we are talking about growth in GDP. Now, coming to the drivers of growth, GDP, as I said, was primarily led by higher investment growth. Investment growth was again driven mainly by government investment, because government investment, the government capex, if we look for the fourth quarter, it showed a sharp jump, and that mainly contributed to a 9.4% growth in investment, which is the GFCF, in the fourth quarter of FY25. Now, this is also corroborated if we look at the construction side, because when you see more capital formation happening, it should show up somewhere on the construction side also. So construction also did extremely well, and various high frequency indicators that capture construction activity also performed reasonably well during this quarter. So that is one area that contributed to a boost in growth. The other is the resilience in rural growth. We've been talking about this, the growth of rural sector, and that continues to exhibit strong growth. In fact, if you look at agriculture grew at 5.4%, and that was due to higher food grain output, lower prices, and even going forward, the outlook for agriculture looks favorable because of the projection of above normal monsoon. So all these things bode well for agriculture sector, and the policy measure that the government has taken, like increase in MSP, is also likely to put more purchasing power in the hands of farmers and is likely to give a boost to rural sector. So number one, investment; number two, rural sector; and services. Now, services sector has continued to show a decent growth of around 7%. There are these intersectoral variations, because within the services, there is financial sector, there is this contact intensive trade, hotel, transport sector, and there is public administration. Now, all these sectors have exhibited various trajectories, but overall the services growth is also quite strong at around 7%. The sectors that have dragged, that is, they continue to be a cause for concern, is one from the production side, which is manufacturing. Manufacturing sector has continued to remain sluggish, and that is something which is a cause for concern. And relatedly, consumption also did not show a massive pickup in the fourth quarter. Consumption grew at a weak 6%, and that also must have got a boost only from the rural sector, because the urban sector continues to remain sluggish.
Great. Now, focusing on one of the points that you brought up, which is that majorly the growth was driven by investments. Now, if we contrast public investments, which you said were the main factor for this growth, with private sector investments, what is the picture that we get about the Indian economy?
Now, that's a very valid question, because if we talk about public and private mix in the overall investment picture, that picture we get only from the annual data, and the annual data also comes with quite a lag. But even when we look at that, and even if we've been talking about this, that the private investment various indicators are showing a mixed picture. They are not increasing, like capacity utilization is not increasing. The bank credit to industry is not picking up. So we have been talking about the fact that the private investment is not picking up, and now that is actually corroborated if we look at the government's official statistics. So recently the government came up with what's called the Government National Account Statistics for 2025, and there they give actual numbers for the private sector gross fixed capital formation as well. And there we say that, we see that the growth from 2022-23 to 23-24 is mostly flat. So what we can see is that there is no significant pickup. Even the government's own official documents are suggesting that the private investment continues to remain sluggish, and that remains a policy challenge. And that will remain unless there is an improvement in business certainty, unless there is improvement on the tariff front. Private investment is likely to remain sluggish.
Right. Now, just very quickly about rural and urban growth, especially in terms of consumption that you were talking about. Can you tell us what were some of the reasons that urban growth could not match up to rural growth, and going forward, what is it going to look like given what we know about the incoming financial year and the policies that the government has enacted in terms of tax cuts or anything else? What is the scenario of urban consumption growth?
So that was one of the main policy priorities for the government when the budget was announced, because consumption continues to remain lackluster, and because rural side is doing well, and again in overall consumption the picture is not coming out very optimistically. It means that it is the urban consumption that is not performing well, and that is reflected in a series of high frequency indicators as well. So now, till now we have not seen, but in this financial year, which is FY26, there we could see some green shoots of recovery on urban consumption because of two major factors. One is that the RBI has already slashed its policy rates by 50 basis points and is likely to cut it further in the June policy. And also the government announced income tax cuts that should also show up in higher consumption levels. So all these things should improve. But there is one very important thing that, unless the manufacturing sector improves, because manufacturing sector is highly labor intensive, it has a great potential for employment. So unless manufacturing sector improves, the employment prospects are not going to be very healthy. So to ensure a sustained revival in consumption, it's important that consumption should rise and manufacturing sector should also perform well. So these two sectors, one from the expenditure side and one from the production side, continue to remain the pain points.
Great. Now I think it's time to move on to some audience questions. So the first one is by Anurag Upadhyay, and he asks, if India achieves 7% real GDP growth, is it better to have 2% inflation implying 9% nominal growth, or 3 to 4% inflation implying 11% nominal growth? Both are within the inflation target. And how will this kind of 1 to 2% higher nominal growth affect the broader economy, that is, government finances, investments, and household consumption?
See, there are two parts to it. One is that the focus should be on real GDP after excluding inflation and other nominal factors. So the economy or the policymakers need to strive for higher real GDP growth. So right now we are seeing a 6.5% GDP growth. Next year also is expected to be around 6.3 to 6.5% growth. So if we achieve a higher real GDP growth, that is the most important the point for the economy, positive thing for the economy. Now, when we talk about nominal GDP growth, a higher nominal GDP growth gives headroom for the government's fiscal indicators, because all the fiscal deficit, tax, all these numbers are benchmarked to nominal GDP growth. So nominal GDP growth, if it is higher, then the government gets a headroom, even if its fiscal deficit absolute level is higher, but the ratio, because your nominal GDP is higher, you get headroom to spend more. Those are some of the policy choices to be made, but it cannot be, the nominal GDP when it is set by the government, when it is projected by the government for the budget document. It is based on several factors that what is expected to be inflation level, what is expected to be the commodity prices, and so on. So it's not that it's not like a mathematical exercise that whether you want to fix it 7 plus 2% or 7 plus 4%. It depends upon the actual macro conditions at that time. But nevertheless, the fact is that a higher nominal GDP growth is good for the government's fiscal side, because it gives the government's headroom to achieve its targets, even if it is not able to achieve in absolute levels.
That makes sense. Now, the next question is by Aditya. He asks, what kind of impact on GDP can we expect in the first quarter of 2025 against the background of tariffs and India signing the trade deal with UK? Can we see any short-term impact, or will impact be visible after a long time?
Yeah, so the trade deal with UK is still being signed, and it will take another 10 months. So the trade deal with UK will come into force only in the second half of 2026. So we shouldn't expect any impact of that in the first quarter of this financial year. And also regarding the trade deal with the US, it's still in the works. We do not know when it will come out. So I don't think there would be any impact of either the trade deal with the US or with the UK on the first quarter. And as of now, the tariffs on India are suspended. The only impact will be, which could be minor impact, is that Trump administration has increased the tariffs on steel and aluminium from 25% to 50%. That could have some bearing on the steel industry, and that could show up in GDP. That's the only channel through which the trade deal could be impacted. Otherwise, the other, on a broader level, there wouldn't be any impact on GDP in the first quarter.
Great. Now, there's another question which talks about how the consumption is slowing down, FMCG, auto sectors are slowing down, the RBI is mulling a rate cut, and hiring is lower than ever in recent times. However, the government is confident of meeting inflation and GDP targets. What is the real picture? If you could tell us something about all the sectors that the question has mentioned, and what's the actual scenario with these sectors?
So actually, inflation is going down due to other factors, because food prices have been going down, commodity prices are going down, crude oil prices are going down. So overall, inflation outlook is benign, and as per projections, inflation could be even lower than the 4% target for this financial year. Inflation could be even 3.5%. So that's a good news that gives the RBI some headroom to cut rates to support growth. Because the only way the RBI can do something to lift growth is by cutting rates. How much cutting rate is again a separate question and a separate debate. But the fact is that inflation situation continues to remain favorable because of low food prices, and even outlook is better because Rabi output has been good. The projection for this financial agricultural year is also going to be better. So all this bodes well for the inflation outlook both domestically as well as internationally. Even if we look at crude oil prices, which is one of the significant determinant of our inflation, it's in a very favorable range of less than $70 per barrel. So all these things, so that is the reason why inflation is doing well. Why we could meet our GDP target, as I said, that is due to one is that government has continued to support growth through investment, and that it is likely to continue, and that could help us in achieving the target. May not be 6.5%, maybe 6.2%, 6.3%, but again, given the global challenges, it is quite a reasonable growth. And again, so agriculture from the supply side and investment from the demand side. These two factors will help. What will not help us is the net exports component, because exports will face headwinds this year. In the last 2 years, exports have done well. In this year, exports could suffer, and they've already, even if you look at the first month's data, we see that there is some headwinds to exports. So net exports, the external sector component could pose a drag on GDP. But overall, agriculture, services, they continue to perform well. So there are these domestic factors that are doing well. But what is important, as I said, is that manufacturing and construction, they need to pick up. But again, manufacturing, there are a host of factors, sector-specific factors, external factors. So that those sectors will take time to pick up.
Now, for the final question, this is by Lakshya. He asks, is the fourth largest cumulative GDP ranking something to boast about when our GDP per capita is still quite low, and which is also deeply skewed by inequality? Why are we not growing faster? He asks. 6.5% is too low. Now, can you give us a picture of what exactly is a high GDP growth rate, and is 6.5%, given the size of India, given our economy, is it an acceptable growth rate or not?
So given the global headwinds, it is an acceptable growth rate. And we must know that the way this third largest economy or fourth largest economy is calculated, a lot of it depends on exchange rate fluctuations. So it is an incomplete measure of the state of growth and welfare of the economy. So we should not just look at this number to boast about, and that's a very valid point made. So it is important to look at domestic factors, and it is important to look at domestic reforms, what needs to be done. Diversification of trade, inclusion of more trade deals, focusing on climate resilient agriculture. All these things are important, and also integration into global value chain. All these domestic reforms, how to improve the infrastructure, how to improve logistics so that there is a greater flow of foreign investments. These are the steps that are important, and not just looking at this one number, which is telling us that Indian economy has grown in size and is now third largest or fourth largest. So that is not something to look at assess the state of growth or development or welfare of the economy. What is important is to look at domestic factors. What is the level of consumption? What is the level of investment? What is happening to rural demand? What is happening to urban demand? And all these taken in conjunction will give us a complete picture about the state of the economy.
Great. So there you have it, folks. Construction, agriculture, and rural consumption is what drove our economy in Q4 of financial year 2025. And services sector obviously remained our backbone. It's witnessed a steady growth. Now, manufacturing and urban consumption are two sectors in which we've not had as high growth, but given the policies that the government has brought in for the coming year, we are optimistic and we do look forward to another steady GDP growth rate. That's all we have for you today. Thank you for tuning into The Print.